Just 1% in fees could result in losing 30% of the value of your investments over time. Imagine that you bought a house for $1 million. In the first year, you have to cut a check for $10,000 to your mortgage broker. And every year after that check, you send out balloons to $11,000, $12,000, $50,000 just because they sold you that house in 2018 and they help you fill out the paperwork. Then imagine after 30 years, you try to sell that same house, but it's worth only 30%. That is what happens when you make one of the number one mistakes in investments. John Bogle's The Little Book of Common Sense Investing is a data-rich trove of information that could help the new or experienced investor avoid some of the most dangerous mistakes as they start on their financial journey. As the founder of Vanguard and the champion and creator of the first index fund, the late John Bogle created more wealth for the individual investor than any other in his generation. I have become a Boglehead believer during my own investment journey, and so will you after this video. Hi, if you're new to the channel, my name is Dr. Dang, the financial neurologist. I'm a board-certified physician turned financial nerd, and together we'll take a look at how your brain influences your personal finance. Let's get started. Mistake number 1, investing in actively managed mutual funds. Imagine walking into a nice restaurant. You got your evening clothes on, you have your date with you, and you sit down at this restaurant. You order something from the menu and it sounds fancy, La Gourmet Gastronomique de Bouffe, and you're ready for a good time. When they hand you the plate though, what do you find? Is a McDonald's hamburger, and they forgot the pickle. This is what happens when you invest in an actively managed mutual fund. They overpromise and oftentimes underdeliver. According to John Bogle, 95% of actively managed mutual funds fail to outperform the comparable S&P indices from 2001 to 2016. In other words, only 5% of actively managed mutual funds were able to outperform a simple, low-cost S&P 500 index fund. The likelihood of you as the individual investor being able to select this unicorn is exceedingly rare, less than 5%. In addition, they oftentimes charge 1 to 2% assets under management fees, as compared to the 0.03% fee you find with a typical low-cost index fund. Why would you pay 33 to 66 times more for McDonald's? Not that I have anything against McDonald's, I love their fries. Which leads me to the next point. Mistake number 2, ignoring the hidden fees. Remember how we talked earlier about how 1% in fees could result in you losing up to 30% off the value of your investments? There are obvious fees, such as the posted expense ratios of the mutual fund or the assets under management fees of the brokerage company. But there are also other hidden fees, such as the money your fund is losing in taxes. The portfolio turnover of the average actively managed equity fund comes to 78% per year, resulting in an estimated effective annual federal tax fee of 1.2% per year. In other words, you will be giving up an additional 15% of your returns every year to taxes alone. Consider another scenario. Dividend yields are a huge part of the long-term return generated by the stock market, accounting for fully 42% of the stock market's annual return since 1926. Because actively managed funds charge advisory fees based on the fund's total net asset, in actively managed growth funds, dividend income is consumed by expenses, sometimes up to 100% of fund income. The contrast here is stark. The comparable low-cost growth index fund consumed just 4% as compared to 100% of your dividend income. This dividend income is important because it is the primary driver to the growth that you see from compounding interest. This, combined, means that you'll be leaving a lot of your hard-earned money on the table to the fund manager and to taxes when you invest in an actively managed mutual fund. Mistake number 3, buying the dip. Buying the dip, or in other words, trying to time the market, is a bad idea. To understand why, let's consider what makes up the value of a stock. In essence, the total stock market return that we see is comprised of the investment return from the actual growth of the underlying business, and speculative return, impact of changing price earnings multiples on stock prices, or in essence, what the people think a company is worth. According to total stock returns by the decade between 1900 to 2016, actual investment return from the growth of the underlying companies has been net positive for every decade, aside from the 1930s during the Great Depression. Understandable. Compared with the relatively stable actual investment returns, speculative returns on the next line fluctuated wildly from decade to decade. Accurately forecasting short-term swings in investor emotions is not possible. It is economics that controls long-term equity returns. returns. The impact of emotions so dominant in the short term dissolves. John Bogle. In summary, when we combine these two sources of returns, speculation contributes only 0.5% to the average annual total return of 9.5%, which means that when investors try to buy the dip, they try to capitalize on the impossible to predict speculation market, which represents a small portion of the actual annual total return on stocks. This, combined with the high fees and taxes from active trading, is inevitably a negative sum game. John Bogle encourages investors to adopt a long-term perspective. Market timing and frequent trading are often counterproductive at best and would result in underperforming assets at worst, exposing you to excessive risk. Holding investments for the long term tends to yield better results with less effort. Mistake number 4, believing that you can select the winners and emotional investing. It is human nature to believe that we are better than average. In fact, it is often the pitch of a financial advisor against investing in index funds, because why would you want average performance? It would only make sense that we would perform better than average if we choose the highest performing stock based off of their historical success. This is a mistake. According to John Bogle, there is little evidence that past performance would persist in the future. Let's consider the record. This shows the 46-year track record of 355 equity funds that existed at the start of 1970. What may surprise you is that 80% of these funds have gone completely out of business. 8% remain, though significantly underperform the S&P 500 by more than 1 percentage point per year. 3% outperform the S&P 500 by 1 percentage point, and 2 whole funds out of 355 outperformed the S&P 500 by 2 percentage points. Let me say that again. Only 2 out of the 355 mutual funds outpace the S&P 500 by more than 1 percentage point per year. The odds that you will own one of these 2 funds is less than half of 1%. Even then, these 2 funds, the Magellan and Contra Fund, have now trailed the S&P 500 performance by 1.5% per year over the past 5 years of the study, with investors since pulling out the majority of their assets in a fire sale. Another aspect of human nature, emotions, is enemy number 1 for the individual investor. Without fail, through investing history, the individual investor typically engaged in counterproductive market timing and react emotionally with devastating results to their portfolio. During the 1990s, investors poured 95% of their cash flow into the latest new economy funds, tech funds, and the hottest performing growth funds, when those funds were substantially overvalued during 1999 and the early 2000s, driven by speculative returns and greed. Then, when these funds followed the regression to the mean towards their true value, they also reacted emotionally, pulling out their money after losing 67% of their asset portfolio. Do not market time, and do not invest based off of the speculative value of an asset, and do not react emotionally to when this value fluctuates wildly over time. As John Bogle would say, don't look for the needle, buy the haystack. Don't spend your valuable time, energy, and money investing in ways that will guarantee that you will have less of it in the near future. When you invest for the long term, you ignore the noise from the short-term speculative changes, knowing that the growth of the underlying business will drive up your asset value over the decades. Mistake number 5, relying on a financial advisor. Now picture this, you're walking into a dealership without knowing the first thing between an SUV and a boat. Finding the first car salesman you see and saying, hey, I have $30,000 burning a hole in my pocket. What do you think I should get? You can see the gleam in their beady little eyes as they lead you to their top of the line model, all the bells and whistles. And when you get to the financing department, they go, oh, ignore that 12% 100-month car note. You can afford that, right, big shot? So when they're through with you, you leave their days with a product you barely understand and might not even want, minus the money you originally had. This is what happens when you sign up to meet with a non-fiduciary financial advisor that charges an assets under management fee, an AUM fee, which is 84% of all financial advisors, without first educating yourself. In fact, according to John Bogle, in a study led by 2 Harvard Business School professors, concluded that between 1996 and 2002, financial advisors cost investors approximately $9 billion per year, while yielding average annual returns of 2.9% as opposed to 6.6% if they bought these funds directly. The study also found that this happened because these financial advisors charged higher upfront fees and recommended that their clients chase market trends, the cardinal sin of market timing. don't listen to a financial advisor. But if you really want to use one, find one that charges a flat fee and has a fiduciary responsibility towards their clients. In the end, it's still better in the long term to educate yourself and invest directly. This will allow yourself to grow as a financially savvy investor, as well as release your investments from the shackles of high fees and high taxes. Want more useful financial insights and life-changing tips? Hit that subscribe button, tap the notification bell, and be part of our journey. Stay tuned and keep thriving.